Welcome to Matters Financial and Geopolitical from a Frontier. Thank you for stopping by. Jomo Kenyatta Airport was chaotic this morning as there was a strike. Nobody knows what's going to happen. This is a photograph, but it now seems to be normalizing. Prime Minister Abiy Ahmed, President Mohamed Abdullahi Mohamed are en route to Nairobi for talks with Uhuru Kenyatta, according to the Addis Standard. A source tells Addis Standard Prime Minister Abiy has stepped up efforts to resolve the recent diplomatic deadlock between Kenya and Somalia, and that there has resulted in a positive development. He really is a dynamic, virilliant, Gladwellian figure. Kenya is discussing a new standby credit facility with the International Monetary Fund after the expiry of a previous program last year. $989.8 million arrangement expired last September. I can just confirm that discussions on the new program are ongoing, said Jan Mikkelsen. Government is preparing to issue a $2.5 billion Eurobond, and analysts say it would get better interest rates if it secured the standby credit with the IMF before it goes to the market. That's a fact, and I think a condition precedent. I was talking about a $3.5 billion call at the end of January. I said then how we now deal with the balance sheet is key, but $3.5 billion call now is tactically the right call because we've had this humongous rally in emerging and frontier market bond prices, and that this kicks the can down the road. I also said it's obvious we're fully loaded, and that's the reason for we are fully loaded. That's why we've got to go to the IMF. This is a phenomenon that's not unique to us. This is what I meant by fully loaded. This is a Citibank presentation, public debt in Kenya via Mohamed Wellier. Going back to my article last weekend, I was talking about greater demand for Kenyan tea from Pakistan, who had lost its most favored nation status with India. And I said these might be salad days for the tea crew, like it once was for the coffee kings, when we were coffee kingpins in the 1970s, and when Brazil's coffee crop was knocked out by a frost. Kenya Commercial Bank, KCB Group, reported full year earnings this morning. Let me read you the salient points. Loans and advances to customers was up 7.854% at 455.88 billion. Total assets up 10.46% at 714.31 billion. Fees and commissions was up 32.988%. Other income up 19.767%. Profit before tax up 16.297%. Profit after tax up 21.77%. Full year earnings per share up 21.773%. Full year dividend payout uplifted 16.667%. They tweeted, and I followed some of these tweets, our focus on customers as well as diversified business model and strong risk discipline helped us to produce another solid year, says Joshua O'Gara. We have 258 branches, 6,220 staff, making us one of the largest corporate employers and serving 17.4 million customers. They are truly a singular East African franchise. They've also given an overview of the markets they're in: Tanzania, Uganda, Rwanda, South Sudan, and Burundi. Have a look at this image. Mobile remains a key channel. Over 88% of all KCB transactions are performed outside the branch. Total loans dispersed on mobile were up 84%. And then saying sustained revenue growth and prudent cost management helped raise KCB full year 2018 net profit by 22%. There's a lot on the website, so do have a look. My conclusions are as follows. It remains a singular East African franchise. The PE ratio is 5.389. That's a steep discount. The price has room for a meaningful 15 to 20% advance, in my opinion. 28th of January, I was writing about how a move below 100 in the Kenya shilling would catch a lot of people off guard. I said every January, every forecast, every year about the shilling predicts a 10 to 15% devaluation. It's mind-boggling. And I was saying remittances are high, oil prices are low, and we underestimate the regional safe haven status that the Kenya shilling has earned. And that's a point David Cowan of Citibank was making yesterday. Country has continued to get other flows of more than $2 billion in our estimates that are coming from regional countries. And therefore, I really believe we underestimate the regional safe haven status of the currency. And I've noticed that these downside moves in the Tanzanian shilling are mirrored by upside moves in the Kenyan shilling. We're last at 100.05. Nairobi all shares up 9.45% year to date. Sanlam Kenya reported some horrendous annus horribilis results, but it was widely forecast because once you saw the half year, you knew it was going to feed in. Fair value losses 1.983 billion versus a fair value gain of 368.951 million last time. Loss after tax is 1.979 billion versus a profit of 53.045 million last time. Earnings per share negative 14.01 versus positive 0.21 previously. They said several institutions in which the group's long-term insurer had invested came under financial distress, which led to the impairment of 1.14 billion in investments, primarily debt notes and equity in Kalu Works, Real People and Athi River Mining. The company's reserving basis was revised, reflecting a more prudent basis described by the regulator, which led to an additional 0.65 billion reduction in earnings. Earnings took a big hit, but it was already factored in. Wazua, a 2.1 billion loss after tax, eerily equivalent to fair value losses equal in size to operating and admin expenses. Borrowings triple, group embedded value halves, no dividend for third year running. And finally, this is another tweet from Mohammed Welie picking up on a Citibank presentation. Take away Safaricom and the banks, and the private sector is practically dead, he says. Thank you for stopping by.